If you are trading supply and demand, but you still get wicked out before the real move, it's not your zone, it's the liquidity sitting above it and the inducement that price needs before delivering direction. Today, I am going to break down liquidity sweeps, equal highs, equal lows, ascending and descending trend lines, and how inducement truly works. So you finally stop being liquidity and start trading like the institutions who engineer it. Today, we are diving into one of the most misunderstood concepts in smart money trading: liquidity and inducement. Not the watered down version, not the aesthetic SMC Instagram version, but the real structure logic behind why sweeps, where it sweeps, and how liquidity fuels every single expansion in the market. If you have ever entered perfectly at the zone only to watch price run your stop loss by one pip and then fly to your target, this video will explain exactly why that happens. Liquidity is not a magic. Liquidity is simply an easy pocket of orders sitting above or below an obvious price levels. Equal highs, equal lows, double tops, double bottoms, clean trade lines, or session highs and session lows. If the level is obvious, it attracts orders, and if it attracts orders, institutions will remove it. Let's start with equal highs and equal lows. The classic liquidity pools. Equal highs form because retail traders believe the market is respecting a resistance. Equal lows form because retail believes the market is respecting support. But to smart money, these areas are liquidity shelves, entire clusters of stop losses and bending orders. So when price approaches equal highs, institutions aren't rejecting the level, they are targeting it. Why? Because the only way a large player can enter a massive position is by triggering enough orders to create the liquidity they need to fill their trade. Trade lines are not support and resistance. Trend lines are liquidity ladders. Each touch of the trend line adds more stops underneath or above the line. An ascending trend line creates stacked lows, that's liquidity. A descending trend line creates stacked highs, that's liquidity. Smart money does not buy off trend lines, they attack trend lines. Why? Because every retail trader who buys the third trend line tab has a stop loss right below that line. That cluster of stocks become inducement. Inducement is the move before the real move. Inducement is the engineered behavior convinces traders to enter early so their stop losses can provide the liquidity for the real institutional entry. If liquidity is the fuel, inducement is the spark. Inducement can be a fake breakout, a third trendline tap, a liquidity grab, a small pullback into a micro demand zone, a clean change of character with obvious structure. Inducement is simply price action that creates belief. Belief in continuation, belief in reversal, belief in a breakout, and once enough traders are induced to enter, their stops create the liquidity required for smart money to place real size. The pattern repeats every single day. First, build liquidity, equal highs, equal lows, or trend lines, obvious levels. Second, induce retail into a premature entry, fake respect, fake breakout, micro pullbacks, sweep the liquidity. It is the third, top hunts, weeks of violent spikes. And fourth, return to the true zone, that unmitigated supply or demand area institutions actually want. And fifth, deliver displacement. The real move begins once liquidity has been collected. Here's a real example of Euro USD. First thing you can see here is a small trend line build up or descending trend line. Price first induced low, mitigated a BOI somewhere here, mitigated this point of interest, then price went up, created another liquidity, a ascending liquidity as you can see. Let me mark it for you. Now, this inducement is kind of confusing, but after building a liquidity and ascending trend line liquidity, price actually induced high, mitigated supply on the left, price induced high, mitigated supply on the left, then gave a change of character. This trade I took it, then gave change of character to go lower. I knew once price hit this low, this is the bottom of the ascending trend line. After hitting this low, I knew the inducement is mission or the inducement purpose is already over. As you can see, after inducing this low, price went ahead and mitigated this demand, and check it out what happened. Price went up. As you can see, as soon as you understand how liquidity sweeps or liquidity build up and inducement works, you can easily identify your bias. Let's say my bias ends here. My bias was after building up this liquidity, then induced high to mitigate supply on the left. I knew my bias of selling would be over on this low, on this ascending trend line low, as you can see, because after inducement to into mitigation, price needs to take liquidity again. Price went down to liquidity, mitigated another valid inducement, as you can see. Then price, before mitigating, as you can see, made another build up of liquidity. If we mirror it, it makes sense. As you can see, we have at least few touches here. On the lower trend line, we only have one touch, but you can see Victor candles, 1, 2, 3 candles, a Maraboso or Victor candle, very strong candles, indicating that this is inducement, induce this trend line to mitigate this demand to go higher. If you found value in this breakdown and you want deeper mentorship on liquidity, inducement, and high probability entries, my private mentorship is open. I work with a limited number of traders and we focus on refining structure, liquidity, reading, and execution until you can trade with confidence and consistency. The link is in description if you want to apply.